Let's get at it right now. Kicking us off, Keith Springer. Keith, you were positive the last time you joined us here on Street Signs. I know you still remain positive through the year's end. Let's say it again. Italy and Berlusconi. How much is that as a financial advisor on your radar right now?
Brian, it's basically just a distraction. What we're seeing with Berlusconi, the whole European situation, it's becoming old news. Not that it's not going to be an issue down the road. I think we all know it's going to come back and bite us down the road. But for now, it's more of a distraction. I think the market, I think investors are really going to start to focus on the economic numbers, which aren't great, but better than expected. I think the earnings have been very good. I love the sentiment out there, which is so negative. You know the market loves to climb this wall of worry. There's a lot of positives. And the biggest thing, Brian, is you don't fight the Fed. We've got what I call QE mini-me with low interest rates for probably years to come. There's a lot of opportunity. I think the market's ready to take off, at least through the end of the year.
Let's get to your point about mattering, right? Because I get two kind of tweets, right? I get, "You stink, Sully." That's the most common. The number two one is, "Will you shut up about Europe because we're tired of hearing about Greece and Italy and all these things. Can you focus on fundamentals?" We're trying. We have talked every day about how good earnings have been, but Europe still matters, does it not? Keith, tell our viewers right now why, despite all the fundamental things going on here and things are getting a little bit better, we have to pay attention.
Well, it's exactly what I write about in my book, Facing Goliath. Europe matters because the whole developed world is basically aging at the exact same time. We've all promised ourselves, every generation in the developed world has promised ourselves too much when we retire. The Greeks did it. They retire young, and they promise themselves too many parties, so to speak. Retiring at age 50. You've got Europe wants, in early retirement age. We've got Medicare, Medicaid, Social Security. Entitlements are just too much. And what we're seeing in Europe is we've got the same situation. That's the Goliath I talk about. That's going to be basically like climbing up a wall or slogging up the hill in mud. It's going to matter because eventually these entitlement programs are too much to bear with the same amount of taxes. I'm not saying we need a tax increase, but it's going to be too much for the economy to bear. We have an aging population, Brian. People spend less as they get older. We have an over-leveraged population. These are issues that we're going to have to face down the road.
Quickly, and there are people that will say, because of what you just said, there's no way you can make money in stocks for the next 10 years. Maybe they're right as an index as a whole, but you believe there are individual names. You referenced mud. Let's talk about the other sweet kind of mud, which helps corn grow, terra nitrogen, TNH. Why do you like that?
Well, I think the fertilizers, I think the whole agricultural sector is going to do well. I'm a big believer in investing in the sweet spot. Right now, income and dividends, you can pick up 8, 9, 10% in corporate bonds, stocks like Terra Nitrogen. You've got fertilizer companies, agriculture. Let's face it, the world is modernizing quickly. People demand better and better food as they make more money, as their income grows. And that's why I like Terra Nitrogen.
And one more, and we got to rush on this one. Legacy Reserves, LGPY. Quick take on why you like it.
Well, Legacy, again, is an MLP. You've got a tax advantage on a dividend. You've got a 9, 10% dividend there. It's oil-related. I think some of the MLPs are really attractive here. I love the dividends. I think if you can go after dividends such as Legacy, Terra Nitrogen, and some of the others, you can really find that sweet spot. Protect yourself in a bad or flat market, still do well in a good market, and that's the key, is to take the least amount of risk to get the very best returns possible.
Keith Springer, thank you for rolling with it. We got some breaking news. You did great. Keith, we'll see you again.